How do early investors in companies protect themselves? Now, this is a very tricky spot to be in if you're an early investor in a company, because what happens if that company just keeps growing and you just keep owning a smaller and smaller percentage? Famously, that we had the Facebook case, which became part of a major Hollywood movie at one point, where they talked about the dilution of one of the early investors in Facebook. And this is a very real scenario. Could you put money in a company and then they later just issue more shares and more shares to more people to where your shares become less and less valuable? It's certainly possible. This is where early investors build protections in for themselves. And there's a tension here between the investor and their desire to get in early and to lock the company's future up and to participate in its growth, the company's need for financing, and ultimately, if these provisions are too onerous, if there's too much protection for the investors and the company doesn't do well, we could end up in a situation where we actually run the company out of business because it becomes impossible to bring financing in and the company literally will die. And we've seen those scenarios in corporate history. So what do you do? Well, if you're the investor, you want to think about what protections you want. And there's several of them that are available. The big ones are preemptive rights and anti-dilution provisions. The preemptive rights allow the investor to participate in future offerings on the same terms as other participants. This means they can continue to buy up percentage ownership of the company. Also available are anti-dilution provisions. These are provisions that will essentially keep you from having your ownership percentage get smaller. These are often used particularly when the next offering is a lower price per share than when the investor came in. But these anti-dilution provisions can come packaged in many different ways, some stronger versions, some weaker versions. So we want to think about how to build those in there. The key is, as an investor, to be thinking about that protection early on and build that into those corporate documents. A good lawyer can work side by side with you and say, what are you investing? How's it going in there? What is the future of the company? And how do we protect you? And a lot of times, the reality is the investors build these protections in, and then they have to be negotiated as the company ebbs and flows. That's okay for the investor because they get a seat at the table. But a lot of times the company is concerned of how friendly will the investor be or not be. That's why these are super important provisions, and they need to be negotiated back and forth the right way from the early days of the company. If you have questions about investors and investor provisions, go ahead and drop them below. But remember, questions and comments on a channel like this are not confidential. Don't put anything there you don't want other people seeing. Hope you join me in those comments if you can, and subscribe to the channel and go check out our library of past videos for more tips about business.